Welcome. Thanks for joining us here on Market Call. I'm Morello Fernandez. John Stephenson on the show today. He's president and CEO of Stephenson and Company. He's going to take your questions on North American large caps and resource stocks. Here's how to reach us. Call us toll free 1-855-326-6266. You can email your questions as well today. You can do that at marketcall@bnnbloomberg.ca. Thanks for coming in. Good to see you.
Good to see you.
Let's talk a little bit about the TSX and where it's been. It's up today about 34 points, but it has been in record territory routinely since, I guess, April. Is there more strength to be gained at the end of the year?
Well, I think there has. Look at, historically, and I think now as well today, the TSX and the U.S. Markets are somewhat linked. I mean, we're more resource focused, and we've had several headwinds in spite of the high valuation, namely energy, which is clearly in the deep value category, as well as industrials. But I think we're poised for continued strength in the markets into the end of the year because we traded a relative valuation discount to the U.S. markets. And I think that will close as well. Earnings from the TSX constituent companies are likely to increase. And I think that will all work in the favor of the TSX, as well as increasing confidence in the market. And with that, you get those incremental dollars coming back. A lot of them are chasing U.S. tech names, for example. And so when they start coming back, as the earnings turn a little more positive and continue to grow, I think you go higher.
Okay, so you anticipate earnings improving for the second half of the year, despite the on-again, off-again tariffs from Washington, and despite the fact that we don't have a trade deal in place to know where that will settle?
Yeah, in spite of all of that, I mean, it's clearly been a headwind. It will increase some volatility, but I think we still move higher in the course of the year, the balance of the year, in the next 6 months or so, because the fundamentals just are in our favor.
Okay, do the weaker job numbers, both here and in the U.S., concern you at all?
I mean, I don't think we're headed for an all-out recession in Canada. And so given that, and the numbers have been all over. I mean, we had strong job numbers the month before, weak ones just currently. So I think it's hard to really discern a trend at this point, to be totally frank.
So it is, as you mentioned, hard to see. But if we don't have a full recession, you anticipate carried on weakness at least?
I think we're going to be somewhat weak until we have this overhang, removed. But I think, truthfully, even if we had a deal, I'm not sure it's worth much in any event. And, we could be right back there. So I think we're into an era of the next 3.5 years, likely, and perhaps longer, hopefully not, but of weaker signals on the trade front. But hopefully we continue our efforts to diversify, and that will help. And again, being, a value play, that really helps a lot.
Got it. Okay, we are going to take a quick break. We'll line up some phone calls for John. John is with Stephenson and Company. He'll take your questions on North American large caps and resource stocks. Here's how to reach us. We're back in a moment. Welcome back. Thanks for joining us. We are going to an email first. Bruce writes in, out of the gold stocks, would you buy Agnico Eagle? Very well known and does pretty well. Is this a stock you would buy?
I think it's something that most investors hold, but right now it's fully valued. So I think, if you'll hold it, fine. But if you're looking to buy more of it, I would be inclined to hold off. And it's also faces a growth deficit relative to its peers. So I think if you're looking for something, what it has going for it is in safe jurisdictions, an excellent management team, all of those are huge pluses for it. So it is, a benchmark name for many investors. But maybe something like B2 Gold would be good. It has enormous opportunities. Now you're swapping those. You're in Mali and Indonesia, so you're going to more potentially problematic jurisdictions. But it's an excellent management team, and I think it has outstanding prospects. And you might have more torque to the upside.
Is Indonesia sort of a jurisdiction that is questionable, hard to work in?
No, not particularly, but it's certainly less, safe than Northern Ontario or Quebec.
Got it. Okay, let's go to the phone lines. Elizabeth is on the line. She is in Edmonton with a question. Hi, Elizabeth.
Good morning. My question is on Constellation Software. I would like to know what your outlook is for it going forward, and if AI will, if they are adjusting to AI.
Okay, thank you for the question. Let's turn that over to John, Constellation Software.
I think it's a really good name to own. It really is an excellent company. It executes well. It's a growth by acquisition story, but it does have strong growth, and it really is a champion in the Canadian equity universe, especially in the tech universe. So I would say yes, absolutely own it, and you'll be well served.
There are concerns that once you start to buy, eventually you hit that wall where what else is left to buy or what is bigger for you to absorb. Do they face that at all?
Well, they've been buying stuff in Europe. I mean, I think the world is global and their opportunities are global. It doesn't seem to be running out anytime soon, so I don't think it's something that investors should be overly concerned about.
Got it. Okay, let's go back to the phone lines. Chris is on the line. He's in Victoria with a question. Hi, Chris.
Hi, Morella, and welcome to the show, John. I'm hoping to have your opinion on copper in general, and maybe if you think Freeport-McMoRan is a good pick in the space. It seems to be one of the biggest players, diversified, as stable as copper stocks come. And I'd appreciate your thoughts. Thank you so much.
Thank you for the question. So there's a space that got hit by tariffs, right? Copper, which everybody needs and will need in the future. So where are you landing on the copper space?
I like it, and Freeport is an American company, so it has that plus. I think copper is something very much in demand. Of all the base metals, it's probably the most important, and I think Freeport would be an excellent choice for a viewer to invest in.
Do you worry about the heavier sort of tariff situation? Because it sounds like one of those metals that as demand continues to grow, it'll catch Donald Trump's attention more so in the future.
I think, it's hard to calibrate your investment strategy based on random tweets out of the White House. I would say that this is a key metal that is extremely important for the industrialized economies of the world, and that it will find markets no matter what the tariff regime is, because it's just that important.
Got it. Okay. I hope that helps you out, Chris. Let's go to Wade, who's calling from Ottawa with this question. Hi, Wade.
Hi.
Go ahead.
Thank you for taking my call. I'm phoning to get your guest's opinion on what he would think on a gold play between Alamos Gold and Kinross.
Alamos Gold and Kinross. Okay.
Well, in Kinross, I think maybe Kinross over Alamos, but both are excellent names. But I think Kinross maybe just a little more growth oriented right now.
Okay. So generally speaking, we talked about Agnico Gold. Would you buy in at where Agnico is now, or you're saying if you hold it, if you already own it, you would just hold?
For Kinross, I'd buy in. For Alamos, I'd consider buying in, but I'd prefer Kinross. If we're talking Agnico Eagle, then I would say I would hold it, because I think it's fully valued here. It does trade at a premium relative to the group, and it reflects all of the positive attributes we talked about, the management, the stability, the geopolitical stability, et cetera.
What do you think about the price of gold? We've hit record highs again. There's been concern about, again, tariffs on gold bars coming into the U.S. That has been pulled back now, but it did send gold back up higher. Where do you land on the price of gold moving ahead?
I think it's toppy at this point, but I think it holds in there because there is this uncertainty, which doesn't seem to be, being alleviated anytime soon. So I think, it's not going much higher, but it's not going lower anytime soon.
Okay, so it'll maintain or move up, you think?
Slightly.
Got it. Okay. We are going to take a quick break, then we'll be back with more phone calls in just a moment. Stay tuned. Welcome back, and thanks for joining us here on Market Call. Let's go to the phone lines. Peter is on the line with a question. Hi, Peter.
Hi, thanks for taking my call. John, great to see you again. My question is on Algonquin Power, if you would, please.
Okay. Algonquin Power, I guess just a general comment on whether it's a stock you like?
I think it's a stock I is an improving stock that I like. I would
Tell
say,
me a bit about it, if you don't mind.
well, sure. This is a company that kind of blew up a few years ago and is in a bit of a show-me situation with the market, but the valuation has come way down. They have attractive alternative energy portfolio, and so far they've been, doing what they say, walking the walk and talking as well as talking the talk. And I think this is a company that, it's probably a little early to be aggressive on, but I think coming into the 26 period, especially as investors roll forward their expectations of earnings in 26 and 27, as the calendar moves forward, I think this is a name that you could comfortably own. So I'd say it's a hold for now, but maybe in 5 or 6 months, look at it again and start building a position.
What led to the blow up?
Oh, wow. It's just they essentially guided to different numbers, cut guidance, cut their dividend to zero. That was basically it. It was, I think, a yielding, I believe, at the time, close to 10%, which is generally a warning sign for investors that it's not positive to have that high level of dividend. But as I recall, it was a massive dividend cut.
Got it. Okay, let's go back. Let's go back to the phone lines. Bob's on the line with a question. He's in Toronto. Hi, Bob.
Yeah, hi, Morella. Thanks for taking my call. John, I'd appreciate your comments on Paramount Resources. It's paying a relatively good dividend, and I'm wondering if you think there's going to be some impetus, something to drive the stock higher. Thanks a lot. Have a great day.
Okay, thank you for the question. So Paramount.
Well, with Paramount, it's a good company. I think, in terms of what would be the impetus to jog it higher? I think the reality is higher oil and gas prices are the impetus for any commodity price. I mean, the quarter was good, production was good, everything was decent about it. There's nothing wrong with the name other than the fact that, we've seen over time, oil prices in particular, and gas was weak this last week. There's just very little impetus for the commodity to move higher. Although I do think crude oil could be a surprise. Gas is probably range bound. It's been the much more stable commodity of the two, but crude oil could surprise to the upside.
Why do you think that?
Well, a couple of reasons. One, you look at the setup for it. It went higher. It was over $70 a barrel based on the Iran-Israel conflict. That was one or war. Then there was the report that OPEC plus production was going to exceed capacity and you'd have too much supply. Well, those barrels really haven't shown up. Like if you look at crude oil inventories, if you look at the spreads between the crack spreads, they're at normal levels, so what it's refined into, products looking at normal prices. And so inventory levels of both product and crude oil are at or below the long-term average. So it doesn't seem those barrels have really shown up, even though you would think that they might. So I think the fundamentals may actually be stronger than the market thinks they are. And, well, it will probably take improving overall global economy to really drive crude numbers higher. I think the fact that it isn't as bad as people think, it may turn out to be a surprise for many.
Got it. Okay. Let's go back to the phone lines. Elliot is on the line. He's calling from Hamilton, Ontario. Hi, Elliot.
Good afternoon. The coming hookup between Palo Alto and CyberArk seems to be extremely positive. What's your assessment going forward? Thank you.
Is this a stock that you follow?
No, it isn't.
Not really. Okay, so we're going to pass on that question, sadly. Hopefully we can get to it later in the week. Let's see if Michael has a question today. Michael, what's your question? Michael, are you there? Okay, we seem to have lost Michael. I want to get back into the concept of natural gas versus oil, because a lot of people are thinking natural gas moving forward is the way to go now that Canada has a way to get that product out to international markets. Do you think that the price will continue to go up? Because right now it's a little bit flat.
So it's going to likely remain flat for a while. And the reason is to get full production out of LNG Canada and get full ramp up is sort of 8 to 9 months away. So you're not looking at an immediate solution. I think, gas is driven by different fundamentals than oil. That's the first point I'd like to make. Oil is really a transportation fuel. It's a global fuel. And so it really is dependent on global economic growth, which is around 2.5%. That's what it's forecast for. So it's not amazing. It's okay. It's decent. It's positive, but it's not, enough. And natural gas is much more affected by things like weather because it's used so much in, electricity production, as a feedstock for electricity production. So for all those reasons, it's not, there are other dynamics that impact it. But yes, AECO prices are at a low. There's tons of inventory right now. That overhang will bleed off when we get more LNG coming through the system and going out to Asian markets and other places, and when we have that optionality. But it's just not going to happen for another 6 to 9 months, call it.
And there is that natural appetite for natural gas in the international markets?
Oh, absolutely. And it trades at a premium to U.S. prices. Henry Hub prices, because it's a very prized, commodity, because it's very easy to build power stations with natural gas. It's a relatively clean burning fuel source. I mean, look at the U.S. It was at 1.55% coal. Well, that's all been replaced. It's down under 30% generation by coal. That's been replaced by natural gas because it's modular. You can bring on, 1,000 megawatts of production at a time. So it's much easier to stage in. Plus it's clean burning. You don't need all the scrubbers and everything else you need with a coal-fired plant to remove some of the carbon from the atmosphere. It's many people consider it a transition fuel as well because it's not as carbon intensive as oil, and so it's of the hydrocarbons, it's less carbon intensive. So it's one that can bridge the gap until we eventually, at some future point, who knows when, but at some future point, get to a clean energy future where it's being produced by wind, solar, and tides and other things. But I think it's here to stay for quite some time.
Got it. Okay, we're going to take a quick break. We're going to be back with John in a moment to answer some more of your questions. Stay tuned. Welcome back. Thanks for joining us. John does not have any past picks, so we are just going to continue the conversation and take some more phone calls. We had talked a bit about crude, and you think it'll do better at the end of the year or in the next cycle. Crude was at about 70 at the end of July. It's come down to about 63 or so today. You said OPEC Plus, that hasn't really materialized. So what has actually happened? They were supposed to put more on the market than anticipated. What's actually happened in that interim period?
Well, I think they have actually brought on some production, but I think the backdrop to all of this, I mean, they basically said to their membership, you can bring on more. I mean, that's what it is. And so there hasn't been that. The worry is that the discipline hasn't been there. The restraint hasn't been there from those producing countries. But I think this is why I'm very bullish longer term on Canada in the energy side and in oil in particular, longer term, as well as gas, but maybe a little more so oil, is because when you look around the globe, the traditional basins are rolling over. The one thing about oil and gas business in general is it's a non-renewable. Once it's removed from the ground or its source, there is no more. So it doesn't exist. So you look around the world, the U.S. is starting to decline those fields. I mean, we heard drill, baby, drill.
But where are they drilling?
Where are they drilling?
Yeah.
And are they? But the production hasn't moved anywhere except slightly, sideways and maybe even slightly down. Same thing in Russia. Same thing in the Middle East. The Ghawar field they're putting in, I think it's 7 million barrels of water, salt water a day to try and water flood that, and that's the crown jewel of Saudi Arabia's production. You look at Mexico, it's rolling over a little bit. So really, all basins, are struggling with the exception of the Western Sedimentary Basin. And the reason for that is we really, have underdeveloped. We have oil sands, which, yes, is a stickier,
intensive
and energy intensive, but it's competitive because these other basins are struggling so much that they're finding in development costs are above where they are. So really, what's handicapping us as a nation is a lack of egress. How do we get this out of the ground into markets? And that's what hopefully Bill C-5 does. It moves the agenda forward. And if Carney and the Liberals are sincere in moving this forward, and I believe they are, then we've got to get on it because we've got a golden opportunity to be, truly be an energy superpower.
Are we helped by the possibility of tariffs on Russian oil, which is another thing Donald Trump wants to introduce?
Yeah, that's another slight positive, or raising the tariff on India because they're buying Russian oil. All those things help because Russia has been just putting it on the market and disguising ships, et cetera. Removing transponders, whatnot, to bring it to China, et cetera. They have circumvented the many of the tariffs on them for the role in Ukraine. But I think even Russia itself is rolling over. So I think longer term, the bigger picture and story here is that we are sitting in the catbird seat with this crown jewel, and we better do something to develop it because it's that important.
Got it. Okay, let's go back to the phone lines and take a phone call from Michael in Montreal. Hi, Michael.
Oh, hi. My question is regarding Intact Financial. It's a stock I've owned for a few years, done very well, but it's declined around 10% in the last month. And my question is whether there's an issue or if this is a buy the dip opportunity.
Okay, so great question. Let's have a look at the line chart for Intact at the 279. And yes, it has been on quite the decline over the past few weeks. Any reason why?
Yeah, so they had their mostly recent earnings, and they brought their revenue number down. And their guide was for lower revenues going forward. So they had painted a slightly negative picture, but none of that impacted their bottom line. So the bottom line met expectations. This is one of the premier names, in the insurance space, obviously in property and casualty. I think this is a name that is a buy the dip opportunity right now. I don't think you should be worried about it. It still trades at or below its norms for the last 5 or 10 years in terms of book value per share. I think roughly 2.5 times. Any kind of metric you want to look at on this stock, it's trading in that range of where it's been before, and it is a premier name. So I think this is a golden opportunity to buy it, and I wouldn't let it slip.
So it's overreaction, you think, by investors to the latest news?
It was just the headline news, and I think right now it's the fundamentals are very, very solid on this. I wouldn't be overly concerned. I'd be a buyer at this level.
Okay, let's go to Casper on the line from Kelowna, BC. Hi, Casper. Casper,
Hello.
Are you there? Hi, what's your question?
Yes, my question is on an oil name called Strathcona. I'd like your guest's opinion on whether it's a buy with or without the purchase of MEG Energy.
Okay, thank you for the question. That MEG Energy deadline's in September, I think, Strathcona.
Middle of September.
Okay.
I think it's the 15th or 16th. So I would say it's a hold. I mean, it's not bad. I prefer MEG, truthfully, to Strathcona. I think, Strathcona is good. It has a long reserve life index. It's not a bad name, don't get me wrong. It's just 80% owned by the Waterous Energy Fund, so you have less liquidity as an investor. And you've got, the assets are dispersed. There's several assets in different regions, in Lloydminster and other places. So, whereas MEG has just really Christina Lake, so one major asset, which is a world-class asset, and a better asset than the others, so it has an even better profile. It's just an opportunistic time for Strathcona to make this bid. Whether or not they're successful, who knows? But I would say if I was choosing, I'd be MEG over Strathcona.
What did you think of the bid?
I thought it was opportunistic. Look, it's not the first time Husky took a run at MEG. I mean, it's such a desirable asset, but this has got a very good management team. It's got a world-class asset, top quartile numbers in every step. And there's been a few minor issues and missteps. In the second quarter, they had a fire that impacted Christina Lake. That took, I think, around 12,000 barrels of oil production off out of 100,000 base, and then there was a turnaround also in that same quarter that took around 35 or 36,000 barrels off. So, you know, on the headline it didn't look good, but overall it's going basically according to plan, with the exception of this this fly in the ointment, if you will.
Got it. Okay, we're going to take a quick break. We will be back with John Stephenson of Granite Point Research, taking your questions on oil, gas, and utility stocks today. Back in a moment. Welcome back. We want to go right to the phone lines. Daniel is holding on the line. He's in Markham, Ontario. Hi, Daniel.
Hi, Marilla. Hi, John. My question is on NuVista Energy. Do you own NuVista? And if not, what other Canadian oil names do you prefer to own? As usual, John Gray host and Marilla John Gray guest and Marilla Gray host. Thank you.
Thank you for the call, Daniel. Okay, so let's talk about NuVista. They do oil, natural gas, both. What do you like about them, if you do like them?
I do like it. I don't own it personally now, and I have a couple topics coming up that will answer that question on what else I'd recommend. But you know, look, this is something you can feel very comfortable buying here. It came out in the last quarter, decent production, reduced its capex guide. All those are very positive things for the stock. So there's absolutely no reason not to own it. I just think there may be a few choices that I've hopefully selected that might be a little bit better.
Where does NuVista own?
Well, they're basically Western Sedimentary Basin, like everyone else. But yeah, that's principally where they are.
Got it. Okay, let's go back to the phone lines. Anne's on the line. She's in Scarborough, Ontario. Hi, Anne.
Good afternoon. Don, I've owned shares in AltaGas for at least 8 years. It's about 10% of my portfolio. Should I trim some of it back or just stay the course? Thank you.
Okay, thank you for the question. Have a look now at AltaGas. We'll bring up that chart. What do you think about AltaGas? It's at 41.75 today. It's been on an upward trajectory for some time.
Well, I think the concern is a holding percentage to me. 10% seems awfully high to put, you know, in a single stock. I think that, you know, I would, you know, be inclined to bring it down to 5 or 4%. You know, I think it's just too much, because even though I think it's a great company and I think it checks a lot of boxes for people, you know, it's stable, it's solid, it's been around for a long time, you know, it's a dividend, it's, you know, modest growth, but, you know, it's growing. It's you know, a utility-like stock. It's very good, but I just think the percentage is way too high.
Okay, so you'd half it almost.
Or more.
More. Okay.
It's too much. I think you recycle. And I think, you know, if you're looking for somewhere to put cash to work, maybe just buy an ETF. Like, you know, but a single stock with that much concentration in your portfolio, I think it's just too much.
Okay. And I hope that helps you out. We're going to move on to Mark, who's calling from Cochrane with a question. Hi, Mark.
Hey, how are you?
Good, thanks.
Good. My question is on Vermilion Energy. I wonder if he has a price target and tariff-wise. How is it with tariffs, and does he own it? Thank you very much. I hang up and listen. Have a good day.
Thank you for the question. So Vermilion, first of all, let's pull up the chart. I want to see where it is. At 10.15, do you have a price target on Vermilion?
I don't. No, I don't think. I think the price target is pretty much around $10. Like it's trading where it should. I don't. Vermilion struggled a lot. You know, European gas prices, headwinds with that. Too much debt. I mean, it's been a whole series of little things. I mean, the last quarter was decent for the names. So, you know, decent production and everything, and some, I believe the Duvernay play, they had some good, reasonable results from that. But I don't think there's a compelling reason to necessarily be here.
Okay, so if you own the stock, and as you say, it's now at where you think it should be and might not go much higher, would you settle in here? Would you sell? What would you advise the investor to do?
I guess it depends on your individual circumstance. If you had it at $20 or something and it's now 10, maybe, you know, if it's not too significant a piece of your portfolio, then maybe it's worth waiting. But you're looking at years, I think. If you just were fed up, then and it's a small portion of the portfolio, then I'd probably be inclined to get out and recycle the money somewhere where you're probably more likely to get upside.
Got it. Okay, let's go to one more phone call before we have to end this segment. Tim is on the line. He's on Niagara, or he's in Niagara, excuse me, with this question. Hi, Tim.
Hey there. I was just looking for the guest's opinion on Diamondback Energy in the States. Thank you.
Okay, thank you. Do you know Diamondback?
Yeah, it's one that comes highly recommended. A number of the other analysts who cover it really like this name. Very, very strong growth profile. It's sort of an intermediate, junior to intermediate size, so it's not too big. I think it's very torquey. I think overall this is a name that, is one that I would recommend.
Where do they operate?
Permian, mainly.
Okay, and you would recommend it. You talked a little bit about how much of your portfolio should be in, I guess, oil and or gas. How would you advise investors as far as percentage of their portfolio?
In terms of oil and gas, I would say no more than 10%. I mean, you want to have a portfolio that reflects the broad market. So it's not that significant a portion of the Canadian market. I think it depends on the investor. Some people have time and they can do some of their own work, and they're really interested in the space, and they want to pick stocks. But for the vast majority of your portfolio, I don't think there's anything wrong with having an ETF that broadly represents the market. You get diversification, and you get it at a very low cost. If you want to buy your own names and you want to focus on things, certainly the resource stocks in general, whether they be mining or oil and gas, offer tremendous upside potentially, but they also offer a lot of downside risk as well, because they are variable and they are commodity driven. And sometimes those factors are, pretty macro that drive that. But I think, 10, 15% probably tops. And then you want to have a few banks. You want to have, we don't have healthcare really represented in our index. So you might have to go somewhere else for that, like the U.S., for example.
What about utilities?
Utilities probably even smaller, maybe 7 or 8. Now, it depends. I think some people would be sitting here today where it's a little uncertain and choppy with a much higher percentage of 7, 8%, because, there's such a classic defensive name. And so you see, generally across the utility space, I think they're all, you're buying it really right now for the yield, for the dividend. You're not really buying it for any upside, because all of that's been taken away because people plowed into there, given the tariff uncertainty, particularly at the beginning of the year and around Liberation Day, when it was a total fiasco. But those kind of names are classic defensives, and you want some of that in your portfolio, just like you probably want a bond fund, even though I think bonds have been terrible for a long time. Just for diversification, perspective, maybe a small percentage, 1, 2, would be useful.
Okay. When we come back, I will talk a little bit more about ETFs and if there's one or two you recommend in that space. But we're going to take a quick break. We'll be back with John in just a moment. Stay tuned. Welcome back. We are going to an email now. John, I know you typically do sort of the energy space, but there is an email here on LALA from John. He says, please share your views on LALA as an entry now versus an entry after the upcoming split. Okay, so we'll pull up LALA and take a look. Groceries have been doing fairly well, I guess. Let's have a look at where we are, $229.85, up a little bit today, up 39% in the last year. As an entry, would you get into LALA where it is today?
As an entry, no. I think I think the question was that would you buy it before the split or after the split? I'd probably buy it before, but with this caveat, it's an expensive stock. It trades 1.5 times greater multiple than Metro. It 4.5 or 5 on Empire, which is Sobeys. So it's expensive, and it's a low margin business. Groceries 2-3%. Yes, it's defensive, which is why it's done well. People want to be in these defensive names. You're going to buy groceries no matter what. It's somewhat impervious to inflation because you're passing that through to the consumer. But I think, it's very difficult to see, throwing more money at it.
Would you go to something like a Costco or a Walmart in that same space?
Yeah, I mean, I haven't looked at those names specifically, but I think, Costco is hard to go wrong. I mean, I think it's a fabulous business model in general.
Okay. All right, let's go to the phone lines. Chris is on the line. He's in Ottawa today. Hi, Chris.
Hi, first-time caller, long-time listener.
Welcome.
Thank you. So I did pretty well with Suncor, Enerplus, and Whitecap, but Baytex has been a bit of a laggard, and I'm just still holding it, hoping for something here to come around.
Okay, let's pull up Baytex. It is, I have it at 278. Yep. So $1, 1.6% down today. Not a lot of movement. And what happened to this stock?
Well, I think I think it's the commodity happened to it as the main catalyst, and I don't know that I can offer any relief on that front. At least longer term, I think oil moves higher than this, but I think it's pretty much range bound for the next year or 6 months anyhow.
Would you get out of it if you were? I mean, he's obviously watched it sink and wondering if there's upside to hold on for. Would you get out of it at this point?
I think you can do better with other places in the oil and gas space. So the answer is yes. I think in general, though, when you see something break down, down 10% or so, get out as soon as you can. Like your best advice, at least what I've learned over the years, is to let your winners run and cut your losers short. So.
And is it a 10% drop? You said that if you get to that point, that's when you consider cutting it?
Absolutely, and especially if there's confusion around it, you can always re-enter a position, but you get into a Vietnam type of situation where you can get in, but you can't get out. And then you just watch it go down, and then now you're down 20% and 30%, and you're like, yeah, well, I've been holding this thing for so long. And, and we all have things like that because it's human nature to go in with the expectation of making money, and then when it doesn't, you can't believe it. But by the time you've figured out all the reasons why it hasn't worked, I think it's too late. So I think it's just better to be as disciplined as possible and try maybe either set up a stop loss, when you put on a trade in that same name, and this applies to all names, not just Baytex, but other names. And then as well, just be as disciplined as you can because you've got to protect that capital so you can reinvest it because it's obviously hard if it's been seriously underwater.
Got it. Okay, let's go to Alan, who's on the line from Scarborough, Ontario. Hi, Alan.
Hello. Hi, my name is Alan. Tell me your opinion on CP Rail. It's an oldie and goodie. Is this a good entry point?
Okay, we'll pull up CP Rail. We'll do a comparison of CP and CN as well. I'm just wondering which one you prefer between the two Canadian railways. People always kind of go CP Kansas City because it's got that extra south-moving rail. But what's your take?
Well, I think I'd go with that consensus as well. I mean, it has the better growth prospects going forward. Like both of these companies are impacted by the freight cycle, which we're in a freight recession. We have been for some time. It's probably year 2 of the freight, or 2.5 or 3, even almost at this point of the freight recession. It's been terrible. But, it has stronger growth, has the best management team in the industry with Keith Creel as the CEO. It's just a very strong story, and it's been an incredible turnaround over the last 15, 20 years or so, this name. So I would, put that ahead. I'd also put Union Pacific ahead, although I don't think their merger necessarily is going to go ahead.
If it does, what kind of competition does that provide for CP?
I think it's significant, but it's offering service to a different market. I think the way I'd look at the industry is it's really unusual how the U.S. is structured. So there's 4 rail companies, BNSF and Union Pacific in the west, and the CSX and Norfolk Southern in the east. And we have 2 railroad companies in Canada, CN and CP, but we don't interchange product in Winnipeg or Toronto. It goes all the way through. If it boards the train in St. John's, and it goes all the way to the West Coast, for example, or in the case of CP goes all the way into Mexico. But they exchange, and they do 80% of the time they exchange in Chicago, and they literally truck it off one train, the Western train, Union Pacific or BNSF, and they truck it across town sometimes to other trains, and they put on the product, and that that can take up to 4, 5, sometimes as much as 7 days to do. It's hugely inefficient.
And drives up cost, I'm sure.
Well, it drives the cost of rail is cheap, and that's why it gets business. Otherwise, everything would go truck. I mean, truck is a much more superior service than rail. So it makes perfect sense for an east-west merger because it would eliminate that interchange. But the Surface Transportation Board in the U.S., which is the regulator, is going to look at it and go, I am not approving one merger, I'm approving two. Because there is no way, if they approve the Union Pacific Norfolk Southern merger, that they would be inundated with the very next day with BNSF looking to buy CSX. Because they would not put themselves at the competitive disadvantage by not having an eastern leg. They would just integrate that. And there's no way I think they're going to allow that. It'd just be too disruptive from a jobs perspective. The shippers would probably oppose it because you'd be going down from potentially, depending where their shippers are located, 4 railroads vying for your business to 2. And maybe in some cases just 1. And I think that's not going to happen. Plus, when they approved the CPKC merger, they said that was it.
Okay. John is sticking around to share some top picks when we come back, but that's all the time we have for phone calls and emails. We're back in a moment. Tomorrow, Market Call, Chris Blumis will be on the show, portfolio manager, Raymond James Investment Counsel. He'll take your questions on North American large caps. And if you miss Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. John Stephenson with us. Time now for his top picks. We begin with Canadian Natural Resources, CNQ, on the TSX, a very sort of reliable company, but also has been hit by the downturn in the price of crude. Why do you like CNQ moving forward? Is it just basically because you think that crude will come back up?
Well, there's that, and I think but I think also if you're going to be in an oil-weighted name, you want to be in one of the most diversified. It also produces gas as well, and heavy oil and in situ. It's very varied. It has a huge portfolio of assets. You want to be in something that has an excellent management team, diversity of producing assets. And this is what this brings you. It's a very strong company. It had good production and a little bit of a beat on the production side this last quarter. CapEx has been under control. And I think what it gives you is just a very compelling valuation right now. It's got probably the lowest cost and the longest reserve life of really any oil and gas company, at least in Canada. And all of that is extremely attractive. It can sustain its dividend. It can keep its CapEx program going into the low 40s for crude. So it's a huge amount of downside protection. And it gives you flexibility in that that as a shareholder, last year they returned $7 billion or $7.1 billion to investors. And they're on track to do that again this year, as well as eliminate $2 billion in debt. So I think this is the company that you can put your money away, and for the most part, even though it's an oil and gas company, leave it.
Okay, so put your money in it and leave it for the long term. You're still getting the dividend.
You're still getting the dividend, and you're getting look, we're going through an abnormal time with commodity prices, but I think we break out of here for all the reasons I mentioned, essentially that the rest of the world is rolling over from a production standpoint, and Canada's looking at being the only game standing.
Got it. Okay, let's get to your next pick, which is Headwater Exploration. Tell me a little bit about them.
Well, they are somewhat under the radar, pure play in the Clearwater, which is a heavy oil play, and they have built an enviable land position. They've been exploring on it, they've been developing it, they've been water flooding it, and all of that has led to a multi-year, inventory of producing assets. They've had good production going in the last quarter, and so this is a company that I think has torque to the upside. It's well managed, and this is something that I think would fit into investors' portfolios, and the people who own the Baytexes of the world could consider moving into this name.
I just saw, though, plus 400% over the last, was that 5 years? I wasn't even sure. But do you see, or do you have a price target on Headwater?
I think you can get another 35% off the name from where you are right now. And why it's done so well is the Clearwater has become one of the most economic plays. So this is a way to play this and if you want exposure to that play, the Clearwater, this is through this company, Headwater, you can get that direct play because it's a pure play and just that play.
Got it. Okay, let's get to your third pick then. Tamarak Valley is your third pick here. Tell me a little bit about Tamarak Valley. Is it also Clearwater?
Yeah, the Charlie Lake and Clearwater. So it's in both. It has, production was up, capex was down in the last quarter. So there's tons to like. It's been very acquisitive. It's improved its reserve life index over time as it's moved into these plays. So again, you're getting that. I think you have even more upside potential in this stock than the other, but it's very positive because of all that.
What's a dividend on something like Tamarak Valley? Do they have a dividend?
I think they all have a dividend with very few exceptions in the oil and gas. That's been one of the structural changes that have happened, but it's modest. You're not buying it for the dividend, but though you get it along with it.
Between the two, you said there's more upside for Tamarak Valley, you think, than for Headwater?
I think so. I think it has more upside potential just because it's slightly more diversified and it has such a big inventory position.
Okay, and when you talk about sort of making sure you have a diverse portfolio overall, how much would you dip into either of these?
If it's a truly diversified portfolio, maybe it's 0.5%, 1%, maximum 2-3% of your overall portfolio.
Got it. Okay. We are going to leave the conversation there. We thank John for coming in. Thank you. Appreciate that. And thank you for watching Market Call. We'll see you again tomorrow.